So we're going to switch gears in this part, and what we're going to do is we're just going to ask a question. Is it reasonable to expect the Fed to do a good job? Okay, so we're just asking, is it even reasonable to think that the Federal Reserve could do a good job? And we're going to make one key assumption. Okay, and this is the assumption. Remember, the role of assumptions is to sort of make the model simpler without losing real-world tractability or real-world relevance. Okay, so I'm going to assume one thing. I'm going to assume that Janet Yellen does not know everything, but can probably figure them out. With time. Okay, so I'm going to assume that Janet Yellen doesn't know everything, but that she can probably figure things out with time. Okay, and this is Janet Yellen, of course, is the current chairperson of the Federal Reserve in the United States. And so what I'm saying is that the leader of the Federal Reserve does not know everything, but she can probably figure it out with time. This is the same thing as thinking about, any of your math exams. You probably don't know the answer to every single possible problem, but if you learned mathematics, right, you can figure out the answer, right? So you probably don't know the answer to, if you've taken calculus, from 1 to 27 of, let's say x squared dx, right? You probably don't instantly know the answer to that question, but I'm sure some of you are already doing, is figuring out the answer to that question, which is great. Pause the video, find the answer, and you know what? You can even tell me. Leave it in the comments, and I'll substitute it in there with some sort of an annotation or something, because I don't want to solve it either. Okay? And so you can figure this out because you know calculus, but you don't instantly know the answer to that question. Okay? And all I want to do is recognize that Janet Yellen might not instantly know what she should do given the macroeconomic data that she has, but just like you can figure it out, right, so can she. Okay? And so let's just make that one little assumption and see if we can't go from there. Now, as it turns out, by the time that we're in a recession, it's already too late to prevent it. Okay, so if we want to prevent recessions, we have to actually predict them, okay, and then take preventative measures. Economists call this forecasting. Basically, predicting the, in this case, economic future. Okay. And so what this is it's a lot like when the weatherman forecasts the weather and says, tomorrow it's going to rain, except this time we're trying to predict the future of the economy, right? Which is a really big ask, okay? So the question is, can central banks accurately forecast the future, right? And so let's think about what they would need to do, right? They would have to have data, right, on things like GDP, interest rates, unemployment, economies of, of other countries, wage rates, etc. Okay, so let's just think about how they would calculate GDP. Okay, so if we think about calculating GDP just for a classroom for one day's activity, it wouldn't be too bad. We'd just take all the spending that each and every one of you did, add it up together, and that would be that classroom's GDP. And if we wanted to do, the whole universities, we'd have to take, 12,000 people's spending habits, add them together, and then that would be the GDP for that day for the university. And if we want to take the entire state's GDP, right, we'd have to take all the spending habits of every single person in the state, add them together, right, and that would be the state GDP, and then so on and so forth, right? And we can quickly see that just calculating GDP gets really, really difficult and really time-consuming. Okay, in the U.S., we have something like, 308 million people? And so think about taking 308 million people's spending habits times 365 days per year, and that will give you our annual GDP. So to calculate that would be madness. It would take so much time to figure it out. Okay? And so this is what the Bureau of Economic Analysis attempts to do, right? Also known as the BEA. Okay? The BEA attempts to calculate things like GDP. And what they'll do is they'll release what are called preliminary figures a month or so after a quarter has ended, and then they revise those numbers over the course of the next several months, right? And sometimes those revisions can completely change the state of the economy. Just like if I thought, you were going to get the flu and instead you got mono, right? That would change the state of your body, right, in a meaningful way. We can have complete reversals of GDP growth rates, okay? So in 2001, for example, many economists, including several at the Fed, predicted that there would be a recession after the dot-com bubble burst, okay? But the BEA announced a 2.2% growth rate as its preliminary figures, right? So they said, hey, the economy actually grew. You other economists, you were wrong. The economy grew at 2.2%, right? And the professional economists at the time were like, that's interesting. We didn't expect that. But a couple months later, the BEA, so they started off with plus 2.2% growth. And then a couple months later, they released revised figures that actually said that the economy shrank at a rate of 1.1%, right? So on the one hand, the BEA was like, yeah, the economy's growing. And then they were like, oops, just kidding. Turns out it shrunk. Okay, and so this reversal of sign, right, from growing to shrinking, or the opposite, from shrinking to growing, is a lot more common than we would like, or than what we would think. Okay, so really, it's very, very difficult for the Federal Reserve and for Janet Yellen to solve the math problem that she has to solve, because the inputs, the data that she's getting, can be changing all the time, right? Over the course of a month, the data can completely change. It can flip from being growing to shrinking. And so imagine if instead, while you were in the middle of solving this problem, I said, you know what, I'm sorry, it's actually x to the fourth, right? Not to the second. And then I said, oh wait, I'm sorry, no, I was wrong. It's x to the minus 1/3, right? And then, finally, a year later, while you were still, hopefully not still, but maybe working on this problem, I said, okay, turns out it's actually to the 2.5, but we need to go to 24 instead of 27, right? And so that's sort of like what the problem that Janet Yellen faces, is that these things here are constantly changing, which means the math problem, to really boil this down to a very simplistic thing, the math problem that she's trying to solve is constantly changing, okay? And so we call this time of figuring out what you need to do, right? We call this the knowledge or identification lag. Okay, and in a nutshell, we can think of it as, are we in a boom or a bust, right? We're just trying to answer the question, are we in a boom or are we in a bust, okay? But then we run into a second problem, right? We run into a second problem, which is figuring out the solution. So let's call this the solution lag, right? And this is saying once we've figured out that we're in either a boom or a bust, we have to solve or figure out how to get out of it. Okay. So here, we've got to figure out, in the case of the Federal Reserve, we've got to figure out which of the three tools the Fed is going to use, or which combination of tools they're going to use. And then we've got to figure out, how severely we're going to use them, right? Are we going to raise the Fed funds rate or the discount rate by 1/4% or a full percent? Are we going to increase, are we going to buy or sell bonds? And if so, how many bonds, right? Are we going to raise the reserve requirement ratio, or are we going to lower it? And by how much, right? And so once we've sort of identified what the problem we face is, whether we're in a boom or a bust, we got to figure out what we're going to do about this, okay? And so if you want to think about this in terms of medicine, you can think of the knowledge lag as like when you go to the doctor and present your symptoms, and the doctor has to figure out what disease you actually have, okay? Then the solution lag is the doctor figuring out what medicine is going to work for you and what dosage you should take, okay? And so but here's the thing, by the time we figure it out, the problem may have grown or shrunk or somehow otherwise changed, right? But we'll get into that after we do the third problem. And the third problem is the implementation lag. Right? And this is just saying that it takes time for the solution in 2 to take effect. Okay? So monetary policy doesn't work instantaneously. The new money that we put into the banking system, so when the Fed puts money into banks, the banks have to actually lend that money out. That money has to actually be spent, right? And then, and only then, will aggregate demand actually be moved, right? And further, it's tough to predict exactly how that money will be spent, which can also matter. And so at some level, the implementation lag, to go back to our medical profession analogy, is like taking medicine, right? When you take the medicine, you don't instantly feel better because the pill or the medicine itself has to sort of work its way around your body, okay? So what we've got are 3 lags here. We've got the knowledge or identification lag, right, which is just figuring out, are we in a boom or are we in a bust? Then we've got the solution lag, which is where we figure out what to do about it, okay? And then the third lag is then the lag or the time it takes for the solution to actually take effect, okay? And so when we put these all together in our aggregate demand and aggregate supply model, we can find perhaps some troubling results. Okay, so I'm going to try my best to draw this very carefully. Okay, so let's say that we start off in a bust. Okay, so we're in a bust. We're at point A. Okay, so at point A, Janet Yellen and the Federal Reserve sort of collect all kinds of data. Okay, and they collect the data and they start, sifting through it and analyzing it. And what they're going to discover is that the data points to us being at point A. Okay, while they're analyzing the data, it's not like the economy just like sits and waits for things to be fixed, right? The economy starts to adjust. Okay, and we run into, if you remember, the automatic adjustment mechanism. Okay, so the automatic adjustment mechanism in this case is saying that the prices of inputs and raw materials and workers are all going to go down, right? Reflecting the decreased demand for final goods and products, or the low demand, I guess you could call it, for final goods and products. And so what happens is the short-run aggregate supply curve will shift out to the right, bringing the economy to point B. Okay, so we will move along aggregate demand 1 from A to B. Now at some point, the Federal Reserve is going to finish analyzing their data, conclude that we're at point A, and hit us with expansionary monetary policy, right? Which will eventually work its way through the system and be reflected as an increase in aggregate demand. Okay, so let me draw this very carefully. Okay, and so we shift aggregate demand to the right, which means that the economy moves up to point C. Okay, and so now, where we were in a bust before, we're now in a bit of a boom. Okay, and so what should the Federal Reserve do here? Right, the Federal Reserve should decrease aggregate demand, right, by engaging in contractionary monetary policy. But they don't instantly know that, just like Janet Yellen doesn't instantly know the answer to this puzzle, or this problem, I should say, right? And so they have to collect more data, which is going to tell them that they're at point C and that they need to reduce aggregate demand back to AD1. Okay? But while they're doing that, the short-run aggregate supply curve is going to shift to the left because of, again, the automatic adjustment mechanism, right? Input prices are going to go up, workers are getting raises, raw material prices become more expensive. And so short-run aggregate supply shifts to the left from SRAS2 to SRAS1, bringing us to point D. Okay, and then the Federal Reserve finishes its analysis, concludes that we're at point C and we need contractionary monetary policy, which reduces aggregate demand, right, from AD2 to AD1, right, and lo and behold, right, because that's what they wanted to do, because they wanted to move along this line here, but by the time they started moving us, we were up here. And so we move back down to point A. And then the whole process repeats itself in a cyclical fashion that tends to affect businesses, right? And so what we call this is the business cycle. Okay? So what we're saying here is just because we assume that Janet Yellen doesn't know everything, but can probably figure things out with time, right? What we're saying is that the Federal Reserve might, right, and I want to emphasize the might, end up causing greater destabilization in the economy than would otherwise occur. Or to put this another way, the economy is constantly changing, right? And whenever something in the economy changes, private individuals will have a big incentive to figure out how to fix it because doing so earns them profit. Okay, and so what they're saying, or what we're saying here, is that private individuals have an incentive to figure out a way to shift this short-run aggregate supply curve such that the business cycle actually ends on its own. But then when the Fed comes in, they might end up causing the business cycle. Okay. Now again, I'm not trying to, so I misspoke there, right? The Fed might contribute to the business cycle. They don't cause the business cycle. Okay. The Fed might actually end up contributing to it. And this was an insight by a guy named Milton Friedman, who won a Nobel Prize in economics, but also Christina Romer, who was Barack Obama's chief economist for a few years while he was in the White House. It's also a view shared by Art Laffer, who was, if memory serves, chief economist for Ronald Reagan. And so there's lots of economists across the political spectrum, by the way, right? Milton Friedman, very conservative. Art Laffer, also very conservative. Christina Romer, not conservative in the least. There's lots, and these are only three that I can think of right now. I'm a little sick, so I know there's a lot more than just these three. The economists from across the political spectrum agree with the statement that the Federal Reserve might actually be contributing to the business cycle rather than reducing it, right? So in an ideal world, this square here becomes smaller until we sort of zero in on this point E here, okay? And so that would be the ideal world, and yet for some reason we continue to see this square, okay? And so because of this, we may end up having the Federal Reserve contributing to the business cycle rather than mitigating it, okay? Okay, and so that is one potential critique of the Federal Reserve. Okay, they may, I want to again emphasize the word may, they may end up contributing to the business cycle rather than mitigating against it.